The Coke stock Buffett never sold, from $2 to a dividend machine. Imagine buying a bottle of soda for 5 cents at a small pharmacy in Atlanta. It's 1886. On that very first day, only 9 glasses of this drink were ever sold. 9. Not 9,009 in an entire day. Today, that same drink is consumed 2.2 billion times a day in more than 200 countries around the world. From 9 glasses a day to over 2 billion servings a day in 139 years. Now here's the second part of the story, even more remarkable. In 1988, 102 years after that very first glass, one investor put a little over $1 billion into this company. He never, not once, over the following 37 years, sold a single share. Today, just the dividends he receives from this company every year add up to $816 million. That's $2.23 million every single day, landing in an account without a single additional action. That investor is Warren Buffett, and the company is Coca-Cola. Today, we're breaking down the entire story, how a modest pharmacy syrup turned into a global empire, why Buffett invested in it at exactly the moment the company was going through one of the worst crises in its history, and what would have happened if you'd invested just $1,000 alongside him. 1. The humble beginning of a single drink. On May 8th, 1886, a pharmacist named John Pemberton brought a finished syrup to Jacob's Pharmacy in downtown Atlanta. Right there at the soda fountain counter, the very first glass of Coca-Cola in history was poured. Pemberton marketed it as a tonic for all sorts of ailments. The formula included extract from coca leaves and caffeine from cola nuts. The cocaine was fully gone from the formula by around 1903, long before the drink became what we know today. In its first year, it sold an average of 9 glasses a day at 5 cents each. A modest, local start for a pharmacy tonic that nobody outside Atlanta had even heard of. The real turning point didn't come from the recipe itself. It came from one brilliant business idea. In 1899, the company's owner sold the rights to bottle the drink nationwide to 2 entrepreneurs for literally $1. That might sound like a ridiculous deal, but it laid the entire foundation for global scale. Instead of building factories across the country itself, the company created a network of independent bottling partners who invested their own money into local production. That franchise model let the brand grow worldwide without the company itself carrying most of the capital costs. 2. The crisis that almost broke the brand. In 1985, the company pulled off one of the most famous blunders in marketing history. Leadership decided to change the original recipe and launch a new version of the drink, believing a sweeter taste would beat competitors in blind taste tests. The public backlash was so intense that the company had to bring the original formula back to shelves within just 79 days, an unprecedented reversal of a massive boardroom decision. That episode unexpectedly proved something incredibly valuable. People's emotional attachment to the brand was so strong that the market essentially forced the company to correct its own mistake. It was against the backdrop of that very recent, very public failure, just 3 years after the whole new Coke saga, that the next major event in this story took place. 3. Why Buffett decided to buy at exactly that moment. In 1987, the stock market suffered a sharp crash, one of the largest single-day drops in history. The market was scared, investors were nervous, and Coca-Cola's reputation was still a little bruised from that recent failed formula relaunch. And it was exactly at that moment, when most investors were staying away from the market, that Buffett started aggressively buying Coca-Cola stock. Across 1988 and 89, he invested about $1 billion, and by 1994 he'd increased that to $1.3 billion, accumulating a total of 400 million shares of the company, adjusted for later stock splits. Why that company specifically? Buffett's reasoning was refreshingly simple. He wasn't just looking for a cheap stock. He was looking for a business with a genuine long-term advantage, a brand recognized worldwide, steady demand regardless of economic conditions, and, crucially, the ability to gradually raise prices year after year without losing customers. In investing, that ability is called pricing power, and not the soda itself was the real asset he was buying. In his letter to shareholders that year, he wrote plainly that he intended to hold these shares for a very long time. And in his own words, the best holding period for a wonderful business is essentially forever. For what happened to that money afterward? It's been 37 years since 1988. In that entire time, Buffett hasn't sold a single share of Coca-Cola. Not once. By the end of 2020, that invested $1,300,000,000 had grown into a position worth $21.5 billion, a return of more than 1,550%, not even counting the dividends received along the way. Today, that position is worth more than $25 billion, a return now approaching 2,000% on the original amount. And here's the most interesting part. Beyond the growth in share value itself, Coca-Cola pays shareholders dividends every year, a portion of company profits simply transferred directly to shareholders. Today, Berkshire Hathaway receives $816 million a year in dividends from Coca-Cola alone. Divide that by 365 days, and it works out to more than $2 million landing in the account every single day, with zero additional action from Buffett, just from the dividends of one company bought almost 4 decades ago. 5. What if an ordinary person had invested? Imagine that in 1988, you didn't have $1 billion, just 1,000. At the prices of the time, adjusted for later stock splits, Coca-Cola shares cost around $2.45 each. With $1,000, you could have bought roughly 408 shares. From there, the same compound growth math we covered in earlier videos kicks in. The stock climbed in value over the decades. The company steadily increased its dividend. And if those dividends were reinvested back into buying more shares, the effect stacks up exactly like the penny doubling for 28 days straight. An ordinary person who invested $1,000 alongside Buffett back in 1988 and simply held the shares, doing nothing at all, would today be sitting on a small personal fortune, purely from patience and one well-timed decision made almost 4 decades ago. 6. What the company looks like today. While Buffett quietly held his shares all these years, Coca-Cola itself kept growing to a scale that's hard to fully picture. Today, the company owns more than 200 different beverage brands, including 32 individual brands that each generate more than $1 billion in revenue a year on their own. The company's products are served 2.2 billion times a day across more than 200 countries and territories worldwide, meaning nearly a third of the entire planet's population could potentially drink one of its beverages on any given day. Annual revenue exceeds $47 billion, and in the American beverage market, the company holds a share of around 45 to 46%, meaning almost every second soft drink sold in the country is tied to this one company. The company long ago stopped being just soda. Its portfolio now includes water, juices, sports drinks, coffee through an acquired chain of coffee shops, and even ready-to-drink cocktails released in partnership with well-known spirits brands. 7. The real lesson for you. So what's the actual lesson in all of this? It's not to go buy this exact stock. It's the logic behind the decision Buffett made 37 years ago. He bought the company not at a moment of triumph, but right after one of the most publicly humiliating failures in its history and in the middle of market-wide panic. He wasn't looking at the current news headlines. He was looking at the fundamental strength of the brand. The fact that millions of people around the world kept choosing this drink again and again, decade after decade, regardless of what was happening in the economy. And most importantly, He made the decision to hold the asset indefinitely rather than trying to time some perfect moment to sell. That exact combination, buying during fear, betting on real brand strength rather than a passing trend, and being willing to hold an asset for decades, is what turned $1,300,000,000 into an asset worth more than $25 billion today, generating several $1,000,000 a day just from dividends. Wrap up. Let's bring the key facts and lessons of this story together. 1. It all started with 9 glasses of syrup a day at a small pharmacy in Atlanta in 1886. 2. A brilliant bottling franchise deal sold for just $1 in 1899. Let the brand grow worldwide without the company itself carrying the capital costs. 3. Even a brand that's strong once nearly broke itself. But consumer emotional loyalty forced the company to bring back the original formula within just 79 days. 4. Buffett bought the stock right during a market panic and a reputational stumble for the company, not at the peak of everyone's optimism. 5. Since 1988, he hasn't sold a single share, turning $1,300,000,000 into a position worth more than $25 billion, not counting dividends. 6. Today, the dividends alone from that position exceed $800 million a year, more than $2 million every single day. And 7. The company today serves its products more than 2 billion times a day across over 200 countries, remaining one of the most recognized brands on the planet almost 140 years after that first 5-cent glass. If you need to take just one lesson from this whole story, here it is. Real wealth is rarely built on market panic or the latest trend. It's built on a patient bet on something genuinely durable across decades, and a willingness to hold that bet far longer than feels comfortable. Leave a comment and tell me, would you hold a single stock for 37 years without ever selling? And if this story changed how you look at investing, subscribe, because there's a lot more coming on how the wealthiest people on the planet actually think about money.